Alright, hello guys, I'm glad to have you on board again today. I can't record that weekly update in TradingView. I don't know if it's a temporary issue. Hopefully it will be solved by next week. So until then, I'm going to record this one in YouTube. So here you go. We do the same old weekly updates, the one that I would do in TradingView. Though in that perspective, it was an interesting week. Last week has closed a definitely interesting bullish signal in the S&P 500. And if you remember what we stated on the previous updates, we said that until further notice, we're going to have to play with two scenarios evolving in parallel with two different risk managements. Because as we've reversed this weekly context, that could be the sign that the monthly pullback might be coming along the way earlier than anticipated. And then in that perspective, we don't yet know which one of those time frames is going to take over the other one. I still think that the weekly is trending in a wave one extended, though in that perspective, this trend wave can only terminate by two pullbacks. We would be doing the first very deep and painful one, long, very, very profound. We've retraced down to 50%, which is what this line says. This is 38. This is where most pullback generally tend to reverse. But we've got an extended reversal due to the stupid aggressivity on the Fed's communication and rate hike pace. But these things might be actually just temporary, and we'll talk about that later. But the thing is that if we finished with that pullback, then back to all-time highs sooner or later, it might be vertical, not vertical, like I said. This is not the type of all-time highs you want to be excited about. This is just that we're too much bears and we're going to flush them all out and hunt them like beasts. So we're just going to take down every remaining bear in this market until everyone's bullish again. And then, bang, we reverse again to another pullback. And then the final market top with a two final exit structure might eventually take place. So this is option one, the weekly reference chart with a wave one extended that still has some room to grow. Definitely not staggering gains to come, just boring upside potential. In which people will get proven wrong all the time. They'll get too bearish on the support. This is where the market reversed. They will finally go back to, okay, this wasn't so bad. So now it's maybe too optimistic or too late to buy, which will cause the market to pull back again and so on. So not that many gains to make, okay? Wave one extended, make most of their gain in the first stages. So if you've missed on those gains, don't try to catch up on them. It's too late. Just try to take on the crumbles. This is all that's left to collect. They'll try to be smarter than that, okay? So for the S&P 500, what we've had last week, this signal is more consistent with the structure that we talked about. So it is increasing slowly the probabilities of this pullback on a wave one extended to be the right approach. Until then, that also means that those who've taken that risk in here have definitely some supports and okay, give me a second. All right, sorry about that. So in that perspective, this first pullback could be consistent, and those who've risk taken in this area, me included, finally get their weekly closed signal saying that we might take control of prices if we get to validate that signal by pushing prices right up to the trend channel. Of course, the trend channel is pretty far away from now, so don't be overexcited and so on. We're still in the risk area. If you bought those lows, then congratulations, but this is not yet one battle. So don't definitely overexcite yourself. In terms of sentiment, we would see quickly that the professional market sentiment has increased back to more neutral stance. It's still not being bullish. We're still below 50. So like I said, don't anticipate resistance to break like there were nothing. This is not what's going to happen. When resistance break like a nothing burger, it's definitely when the sentiment is a much, much higher stand. What I like still is that we have some rising bottoms in here as well. Even though I generally don't make technical analysis out of these things, it's still something that we can do and we've done recently because, like I said, the market was more trading psychology than actual prices. That was staggering precision in terms of market sentiment. So I can hardly explain that. There's normally not that big alignments in those indicators, but like I said, we've been trading very psychologically more than technically recently. I think it's appropriate time now to go back to technicals rather than just trading what people think. So that's what it is. We'll see all about that. Technicals finally taking over or not is still a big question mark to me, but that's going to be it for this week. In the meantime, just keep on doing the same old thing, trying to have models instead of listening to bullshitters on YouTube or elsewhere. My personal new model update, which I'm going to share with you guys today, is the fact that we still don't yet know anything about what the Fed is going to do on the 2nd of November, even though traders are like 91% pricing in that we're going to get a 75 basis point rate hike, which I tend to disagree with, because it's both inconsistent with what the Fed dot plot says, and it's also inconsistent with what Fed officials are saying, and what I think is getting closer to a softish landing, which is definitely not going to be a soft landing. Don't be dumb enough to think that nothing is going to break in between. Things are going to break. We've been raising interest rates so quickly that, of course, things are going to break. So the plane is not going to land without a struggle. We're probably going to break a lot of things, but what also people got it wrong is when people thought we're all going to die in this plane. I think we're all going to come out of this without too much pain. Some might be injured if they take in too much risks, but we're probably all going to survive that. Okay, so end of the world stuff, like we're all going to die, great reset bullshit and stuff like that. If it ever happens, I don't think that's now. We'll see all about that. Might happen in the future, but for now, probabilities of everything being fucked up, I don't believe it. Though, like I said, this is the belief territory. This is where if you think everything's going to die, well, do whatever you please, but don't be too aggressive, meaning that if you're short selling the market and get proven wrong, you're going to have to accept the loss coming along with it. Don't be bear in a market that goes up to all-time highs. That would be the stupidest thing. Just like I'll personally trigger some stop losses if the market is to deteriorate further. Okay, so that's one thing. My model, like I said, is looking at the 10-year yield, and what I've additioned to this previous model is that I've basically taken the shape of rate hikes on a 75 basis points per meeting type of trend line and a 50 basis point against it. And I've been putting those two. The 75 basis points the most aggressive, so that's the one that's supporting the 10-year yields to rise even faster. So I decided to take that trend line and put it down to the previous market bottom, okay, to show where the most aggressive bond seller shorters, those who bet on rate hikes to keep on climbing at a 75 basis point trend, and against that, those who are back at the previous top, fighting against preserving 50 basis point trend. That would be the sign of Fed not pivoting, not doing any such a thing as trying to do a soft landing, but just slowing down the pace, going out of 75 basis points and back to 50 in a row. A few 50 basis points, meaning that the Fed will still be on a meeting-to-meeting update. They're certainly not going to give us a clear roadmap ahead. They're just going to stop doing 75. That doesn't mean they can't go back there in the future, but until further notice, they're going to switch to 50 basis points per meeting, which in my personal opinion is exactly what the prices told me the other week. Now, like I said, I didn't give a fuck about what has been published by the Wall Street Journal on Friday and how it moved the market. What I pay attention to is that the 10-year yield has reversed into a very interesting technical area, suggesting that yes, the bond traders are also accepting the fact that we're probably not going to get any more than 50 basis points per meeting now. And if that's the case, then this trend line will never be broken, and as long as it's not, then I personally will correspond that to the fact that my model was the right one. We're going to get 50 basis points for now on. That also doesn't yet answer the question on whether we're going to get 50 for this next meeting on the 2nd of November or yet another final 75. I don't know. Until then, I think that if we don't break the 75 trend line, then I think there is a reasonable probability that we get a final 75 and the announcement that the next one, no matter what happened, is going to be 50 and no more 70. Okay? That's one thing that we could get. Okay, so it will be a lot more about the verbs and the communication on the Fed's meeting and FOMC, but until then, like I said, the market is pricing in the 75 basis point for 93% chances. I think the market is utterly thinking too much about the future with so much certainty that I personally think that the only risk is to the upside for stock market and to the downside for bonds. If bonds suddenly tend to reverse course very brutally, even Fed Chair previous Fed Chair Janet Yellen said that we're at a critical low level of liquidity in the bond market, though expect some volatility that can happen. These kinds of reversal can very well happen. If we build a third range boundary on lower timeframes in here, the next leg could be very violent. Though, like I said, the testing level for me in whether or not the 75 basis point granted traders who are 93% convinced are going to be proven wrong is whether or not this trend line is acting as a support. If we go there and if it's rebouncing, I can be 100% sure that we're going to get the 75. Though I think this is where bonds could go. Remember that they're low liquid, which means volatility can play out. So I'll be very much cautiously looking at the 10-year yield throughout the weeks, leading us throughout the days leading us to the 2nd of November FOMC press conference. Okay, very interesting to think of it, but in the future I think there is definitely a good chance that we break out of these 75 basis points. As you can see, these are two converging trend lines, of course, but I think that we're going to break the 75. What matters to me is how long we take. If we break this one before the meeting, you can be 100% sure that we're going to get a 50 basis point. Though I think the market is going to follow the maximum uncertainty path, and in that perspective, I think if we touch that 75 basis point trend line, that could be the sign that the market is now getting too much cautiously optimistic. That could be the sign that the stock market is under overbought territory. Until then, well, we're driving in here, so we're pretty much over bearish rather than the opposite. But as long as we don't break the 50 basis point trend line, I think the market may still hold its current supports. The two pillars in this analysis still remains the dollar, who is still fakingly strong. The junk bonds, as long as they don't break the previous low points, there's no alarm. But remember to put an alert on this one. If we get down to those levels, that means something is breaking with systemic issue and contagion being possibly there. So you really don't want this one to crack down. It's really not good, but it is not the end of the world. Okay, so remember, we might not break a resistance on the junk bonds, and we totally fail doing it, but that doesn't mean we're going to break that support. We could definitely still stay there for a couple of years until, of course, the credit bubble pops. It's going to happen someday. But those who gamble on the fact that it's going to happen next month or next quarter, they're taking huge piles of risk, because if we go back all-time highs, they're gonna have to get the hell out. Remember that short selling comes with interests to pay, and most importantly, time will cost you a lot, because we can go to infinity when on the opposite hand there's a flow limitation. Prices can't go to zero. Remember that when we're buying stocks are not just speculative vehicles. There are some companies which have some locals, some employees and stuff like that. So don't be dumb enough to think that the stock market can go to zero. It's not true. So there are risks and limitations to the downside. There are no limitations to the upside but speculation. Okay, and speculation have proven multiple times in the past that before actually building a market top, you can be proven wrong so many times. Okay, so until then, like I said, lots of models suggest we might go all-time highs again. Not with fierce bullishness, but just because too much bearishness and anticipation of the shit to come. Shit may come, but you don't know when. Okay? That's really what this is all about. The dollar is still very hard to figure out. I think the euro dollar has finally regained some strength, but the USD GBY has traded into some absolutely outrageously stupid territory. And like I said, until I get a monthly candle close with at least 50% or at least an upper shadow candle, I'm not going to trade that asset anymore. It's way too dangerous, way too stupid. This will have consequences. This will break things. But not in the US, this will break things in Japan. But until then, like I said, there are definitely lots of side consequences to what the Fed has done. And it will take a long time to process all these. Okay, so out from the S&P 500, looking at the four pillars, though, VIX, 10-year yield, dollar, and junk bonds will set the whole story. As long as the junk bonds don't break, don't try it into the end of the world territory stuff. 10-year yield now suggests that the Fed is switching to 50 basis point rate hike, not because the Fed Journal said it, the Wall Street Journal said it, but just because charts tend to suggest that the pace is slowing down on the 10-year yield. The dollar might finally reverse, but it's going to take some time because the euro seems to be the strongest currency against the dollar in the short run, though the most likely one to start retracing against the dollar then should follow the other ones, like the Great Britain pound that has been hammered against the dollar. There's really, really deep room for retracement out there. Same thing goes for the Japanese yen. So this doesn't mean reversing, that the dollar goes bearish, but it just means the dollar has been so strong against all other currencies that right now retracement might cause the dollar to lose some strength, which will lift up stocks in the process as well. So that's one thing for the stock market, okay? Then when it comes to cryptos, well, cryptocurrencies in a weekly basis, pretty boring. We're just punting those weeks one after another. Nothing happens. I still stand for what I said. I think the bottom is in. Everyone think we're going to go lower or whatever, or might go lower. I think this is absolutely irrational. But I also don't think that we necessarily have to go immediately higher. I've shared my model that said we are, for some assets who have been taking some negative feedback loops, specifically the Ethereum's liquidations from staked staked ETH, just like atoms who've been absolutely utterly liquidated by the Luna fucking thing. Some others might have had some liquidations in their process, but these are the two ones that were targeted to me, that were absolutely massively oversold for external reasons. So in that perspective, I said these two are under risks of devaluation retracement patterns, meaning that they will go back to the mean without ever letting a chance for the bulls to jump in. They will just start going back to the moving averages. We've seen Atom being way more productive in that stance, and Atom could still have done halfway through it and still have half of the job to do to retrace right up to 22. Ethereum, if it succeeds building the market bottom that we're in, and last week was pretty damn bullish in Ethereum, we might have the higher low points now in the trail line, meaning that we just have to fuck up the bears. And if we fuck up the bears, like I said, lots of things can happen. Ethereum could have a rapid move right back up to 2400. Remember that if we trade this devaluation pattern, the pattern still is viable right now. Everyone think Ethereum is overvalued related to other currencies. Like I said, bullshit. We're so undervalued in terms of Ethereum that I can hardly stand that. Though I don't know the future, so I need to risk manage. We said normally there is a range that builds itself around the moving average. Sometimes it's above, sometimes it's below, sometimes it's across, but always we build a range out of the moving average, and then we break out of this range to the upside right into the Bollinger Band. So breaking out of this range to the upside, which is exactly what we're actually about to do in the very short term, I guess, would lead us right back up to 1800, and then of course I think we're gonna have to break this. So that gives me the opportunity, I think, to go 2200 and alike, where another range will have to build itself, remember, until the moving average go flat and start to go reverse course bullish, when we're gonna break above this second range to retrace to the mean value, which still stands at approximately 2900 in Ethereum. So if the devaluation pattern plays in, I'm sorry to say it, folks, lots of bullishness down the corner for Ethereum. I think everyone's going to follow, particularly the atoms, the bitcoins, and the big names. Remember, there are 95 full of shit coins in the market. Some can pump absolutely outrageously. We've seen, like, what the fuck is EURJPY? I don't know where it comes from. Centralized exchange token, I mean, good luck with that. I don't trade that. The fucking Luna stuff, what the hell is it doing here? Lots of things have been pumping outrageously, quant networks and the like. This is not even a cryptocurrency. So lots of bullshit in the market. Though I understand those who say we haven't yet filtered out all the shit, so the bear market's going to keep on continuing and stuff like that. I would also say I have some arguments to oppose to them. So we're going to have to risk manage. I'm not saying I'm the one who's right and you're wrong. I'm the one saying I don't think there's any more lower points to come, because I have suggestions saying this isn't a bear market. This is just the harshest and most violent pullback ever experienced. Probably the last time before such a massive bull market takes this one by the wrong footing end of the stick. Meaning that I think we might be irrationally bullish afterwards, just because too many people just lost faith. But if you remember the model that I've followed all along, which is the revolution model, just give me a second to pull it out. Yep, sorry, this one wasn't translated in French or in English. But the thing is that basically we would be there, meaning that the old world has adapted. They're thinking that they'll go back to business as usual. You know, we're pulling secret stuff bullshit like quant network, and we're going to get our same old control over the markets. You trade on public ledgers. We got our own private bullshit stuff to run the business as usual. But like I said, I think these things are not going anywhere, but this is just my point of view. Though I think there is some partial control in the market, but those who will make mistake will think that, well, in the end, crypto is here, but we can still do business as usual. They're wrong. Things have changed a lot. Those who will go revenge or punish those who try to shift the gamble are going to have some absolutely bad decisions as well. So like I said, those who short cryptos now because they think prices are going to lower, good luck with that. If you're trying to punish those who are buying the cryptos because you think they're going to have to suffer a massive endgame liquidation, like I said, if you're among the ones fighting against a revolution, boy, you really want to be changing course if you're proven wrong. Shorting cryptos now is absolute stupidity. I've said it multiple times. I might be proven wrong, but I know on which end of that stick I'd rather like to be. Okay, I'd rather like to be on the bullish, patient side of the stick, spot market, allowing prices to go even to zero on speculative exchanges. But until then, no one can force me to sell. Spot, self-custody, go fuck yourself. If you want to push prices lower, do whatever it is that you want. You'll never make me sell. I know these things worth a lot more than that. Until then, the problem is that all of those who were part of the disruption phase, those who thought, well, crypto's the future, bro, they've got too far. Future is us. We're going to take control. We somehow took control at some point, but then came the FUD, nervosity and doubt, and then delusion, which means we just have our thesis being partially proven wrong, but people take it as an entirely flushed out, like crypto is pointless, they're gonna fuck us anyway, we're fucked already, meaning that either you taken too much leverage and you've been put it out of the market against your will, but this is to be translated a mode of response, meaning that you're in a fight, flight, or denial. Basically, the fight response will be, as the market go lower, I'm buying and buying and every day, and I'm reinforcing my leverage exposition until I get fully liquidated. The flight response would be basically, okay, no matter what, this is bullish, it's gonna go up anyway, so I don't care. Whatever, okay? And the denial would basically be the prices are not going down, I'm not going to do anything and stuff like that, okay? So like I said, those who do this, it's going to be dangerous because, of course, it's going to be associated with a lot of pain. If you're just flying away from charts where you should actually having a look at them and say, well, I look at the charts, the time frames are weekly to monthly, I know it's going to take time. This is different. This is not flying or denying. This is just assessing the reality. We've had a harsh pullback. I do anything I can to survive it, but the bullish market will come and emerge out of this. I find the speculative areas in which I trade again, and that's exactly what I personally have done. I've looked at the prices and I defined my next area of intervention, and I decided this was there when I saw this pattern to terminate after two very freakingly aggressive drawdowns and drawdowns on the prices. So in that perspective, I think we're done. I think the bottom is in. I said it and I'll say it again. We can jiggle around this area for longer than that. Like I said, any day there's bullishness, there's not enough supply for everyone. And that's the crucial problem. Lots of indicators suggest this bear market is nowhere compared to the previous one because we're not in a bear market. Okay, we had two legs to the downside, which is consistent with a pullback, though those two legs are outrageously violent. But the thing is that they're still what it is, two legs to the downside. And if we're reversed out of this, back to all-time highs, folks, it's just going to take some time, of course. If I look at the data, I would say that, of course, what the market is doing in the short run is no more than just accumulating a lot of open interest ahead of liquidations. Liquidations go from the bulls to the bears. I don't know which ones are going to be fucked. Actually, both could usually be fucked. The open interest, as you can see, are far different from a usual typical bear market. We have a lot of speculative exposition in the market, whether it is bulls or bear fighting each other. Like I said, I think both, if they're trading short run type of scenarios, can end up being proven wrong. I don't think that this is the rational thing to do. We're weekly to monthly chart reference, which means things can take weeks, not to say quarters, until it actually finally go back to bullishness. So if you're on the bull end of that stick, time on futures contract is a cost, though I don't necessarily think it's worth it. Okay, so try to be as rational as possible. The next technical areas is either we start pulling the bears out of this market, and like I said, if we start to pull the bears out, and if you're a bear, you really should take that stop loss rather than fighting a market that recovers. Okay, if we recover, like I said, this can take form in Ethereum's and Atoms particularly of a devaluation retracement, which means we're going to get consistent higher low points and higher high points until every bear is flushed out of this game. I've seen a lot of thought about Ethereum being not so decentralized, censorship bullshit. Come on. I mean, I'm not even going down this road, okay? So this is what this is all about. Open interest is rising and liquidations are going to happen afterwards. All of the short-term gamblers might take the risk of being liquidated. No one knows which side the market can start pulling its strings on. We can go bear and then bull, or bull and then bear, or both of them until we actually have a trend that emerges. A trend will literally emerge out of this, but you have absolutely no clue which side of the equation you should be in. Despite, of course, absorbing that short-term volatility and being on the right end of the stick when the candle closes are effective afterwards. When it comes to this, of course, doesn't suggest as well, if you look at Ethereum L2, TVL, as you can see, whoa, if that is a bear market, I'm really concerned about, is there going to be enough coins for everyone if a bull market shows up now? Because that would be higher low points, suggesting in terms of TVL, a significant L2 TVL could show up on Ethereum. And if that's the case, boy, that's demand for Ethereum one way or the other. So like I said, I don't know when the bull market is going to show up. I'm not trying to anticipate that. All I'm saying is that, well, if you're a spot market, and moreover, if you are self-custody, when there's nothing you can fear, but just be patient. Assess the reality instead of trying to fly away from it or deny it. We've been wrong-footed. The bull trend is no more, but that doesn't mean bull trend turns, invalidated bull trend are bear trends at all. This is not the reality. We're not in a crash post a bubble. We haven't had a bubble. We had a nice, clearly well-built trend. It's just that it's been wrong-footed by the weekly chart, which has pulled us right back to some very significant level, which is the previous all-time highs of 2018, meaning that we have an overlap, and this is consistent with the pattern that I've mentioned multiple times back then. This is the wave 5 extended, which is very painful, very psychological, but it tells you one thing: if this market is really a trend, then we're not even started yet. The best is for the last moment. The best is going to be in the final bullish wave, which we're going to get us out of area A into value area B, because that's what trend do. They move prices from one point to another, and we're never going back to the original point. So there are really two assumptions. Either those cryptos were full of shit from day one, and they will start to be decreasing over time as their interest and their value decreases, or this was true revolution, and we're definitely going to get the hell out of A to get to some B that no one knows the true value now, but we're going to have to look for that value. And if that's the reality, then this can only be done one way. When we overlap the previous resistance on the support, when the first trend, which actually was a bubble, is almost fully retraced, when the second trend is invalidated, which is exactly what happened, those who were trend trading, me included, took a stop loss at that point, that's just one sign to me that we're shifting, we're shuffling the deck, but the trend is still to come. It's just going to take a different form. It's wave alternatives, it's wave 5 extended structure in my Prezi stuff. And if that's the case, well, like I said, the final wave will be almost vertical. It will be excessive, not because we're in a bubble, just because this should never have happened, okay? Though the next bull wave, if it is, it's going to be very psychological, very volatile in terms of excessive market to the upside. People are going to call for the next bubble building itself. It's not going to be the case. We're looking for B valuation area. So it might be a V top to reverse this thing, but if you think cryptos are going to crash and go right back to the levels we're trading now, if we do this, let me be real clear. We're going to go crazy high, yes, not to the moon, but we're never going to get back to the prices that we're experiencing now. So if your investment thesis has been just like mine, meaning that you're on board for this thing for at least another couple of years or more, and you're not changing anything until then, well, just try to be rational, folks. It's a simple yes or no answer. You're going to be proven right or wrong. If you're wrong, How much can you lose? Were you ready to lose it? How much did you invest? What did you needed that money for? All of these things. I personally have chosen that my money is well placed in here as a hedge against some of the major problems that the finance is experiencing now. That's just the way it is. The money I put it into crypto, I don't expect to sell it. And I've made it clear all along. I'm not going to sell those cryptos. I might need the money for something else at some point, but I'm not nearly even thinking about it until 2024. And until then, well, we'll see whatever happens. I see a lot of people thinking that they know the future, it's all piece of crap, or it's all marvelous and glitter and stuff like that. I would say I am dependent on the charts. All I know now is that I have high likelihood of devaluation patterns on Ethereum and atoms. I think they're severely undervalued. I don't see the pattern anywhere else on crypto's major assets. The other assets are trading weekly to monthly based charts, and in that perspective, be very patient. Though the only way to be proactive with this is try to avoid external cost of capital, meaning that if you're investing on those longer returns, there's some nice gains to make. What the fuck is the point of using leverage when the probability of success means that we're gonna have to get to somewhere 9K in Ethereum? So if this is what the suggestion is, which my model says, well, in that perspective, there's a pretty nice gain to make. What the heck about multiplying capital to just get richer quicker? Don't do it. Just try to play the safe game, spot, self-custody if you can, it's even better. And that's it. Just be patient enough to understand that this can take another couple of years, probably even more. So just try to be patient and understand that anyhow and anyway, if you're in that boat, there's no other way but to understand that. Spot, self-custody, not getting out until the structure itself has fully destroyed. It's just we're shuffling the deck, but the trend is still very likely, and if it is a wave 5 extended, it's going to be crazy bullish, okay? It's going to be excessive, and you don't want to be among the ones who will buy the FOMO trade. You rather like to be among the ones that take on the supply and distribute it after the math has been played. Out of area A into next area B. Accumulate, distribute. That's the pattern that I'm personally doing. That's what I do with my money. I put it in. I know it could be wrong, but if I am right, I'm just going to distribute a portion of that capital afterwards to those who will have to buy in that B area. Like I said, cryptos are not tulips. They're really useful units of account for public blockchains, which is something that we pretty damn much need today. Okay? So that being said, I took another 10-minute free time in here out of the regular 20 minutes. It's been a bit political discussion in the end, but once again, the technicals still say the same old things. In terms of S&P 500, uncertainty is still there between the weekly and the monthly reference charts, but last week has started to improve probabilities over the weekly to be the ones, and in that perspective, then normally all-time highs should be due. How fast, I don't know, but I think the bears are going to be taken down in the process. Same thing is very likely going to occur as well for cryptocurrencies, which is going to have to flush all of those who are net bearish in a revolutionary asset class. And in that perspective, like I said, path to all-time high is a big question mark as well. I don't know how long it's going to take. All I know is that if it ever happens, there's going to be a shitload of volatility of the all-time highs breakout. Because that will be the sign that we've worked around this price area for long enough and that we're going to say goodbye to it and never ever going there again. Meaning that the last ones who will be able to catch prices, consider it as an average. Current average Ethereum price is 2,500. Okay, so like I said, you don't want to buy above average. So it's not when prices will be at 4K that will be rational enough to buy. Rather like if you want to buy these things and if you have the money for it, well, like I said, don't leverage the calls. Don't be dumb enough to do this. Self-custody, be patient, and understand that the limitation is 2,500. When we cross over that level, you start to enter the areas in which it's not worth buying anymore. Okay? So really that's what it is all about. If you had planned to invest in cryptos at whichever point it is, boys, the current prices are very good already. There's no point trying to gasp at the lowest possible ever price by stupidly waiting of an hypothetical final flush to 700 or 500 or whichever fucking bullshit shares I've seen on the internet. Okay? Understand it. If we're playing value, What does it worth to go up to 9,000? It takes a lot of patience and a lot of resilience because it's going to be a long and painful way there. It's going to be excessive and all of these things, okay? That I know, because if we have to get there, there's only one way left to do it, and that's a wave 5 extended. That's a structure that I know very well. It's pretty damn psychologically mismanaged by most market participants, unless those who know how to navigate that. So I know it's going to be volatile, so I don't want to be among those who will buy when everyone will run out of supply and there will be a crazy short-term demand, okay? So that's really what it is. I'm accumulating in the supply area. The supply is nowhere to be found. We're close to 50% available supply on exchanges. So like I said, if demand ever comes back in the markets, there will be not enough supply for everyone. It works for Bitcoin, it works for Atoms, it works for Ethereums, all of the good names. They have less than 20 to 25% circulating supply. So just a bit of demand and everyone will ask for the coins. There is a big difference with cryptos, and I said it from day one. Cryptos can't be created out of thin air. If you have the true crypto, you know how to differentiate it from speculative derivative contracts or whatsoever. You can buy an infinite amount of crypto derivatives, but there is a limited amount of true cryptos which you can store the keys. That's the reality of cryptos. They can't be duplicated magically or whatever it is. People may speculate on their prices, but what has value is custody of these coins, okay? So for those who are in the long run, custody is the way to go. If you can afford it, of course, because that requires hardware ledgers, wallets, and stuff like that. Okay, more than enough for today. I'm going to leave you guys with that long update. See you next week.